you are finally ready to take the plunge into investing, but not sure where to begin. You're not alone. In this video, I'll walk you through a simple step-by-step guide to help you start investing with confidence. Whether you're a total beginner or just looking to sharpen your skills, this is the perfect place to start building your financial future. Let's dive in. After this video, you'll have everything it takes to start your investment journey. You will learn the basics, how to set your financial goals, understand diversification, risk, and much more. First, let's start with the basics. Risk. Every investment comes with some level of risk, meaning there's a chance you could lose money. Risk just shows you how fast and how much money you can lose from an investment. Return. This is the money you make from your investments, usually expressed as a percentage. You probably heard of the term ROI, return on investment. Portfolio. This is the collection of investments you own. Diversification means that you are spreading your investments across different assets to reduce risk, what we already talked about. And compounding. Compounding is the secret to wealth building. Your earnings are reinvested to generate more earnings over time. So your portfolio grows exponentially. Now, why should you invest? Because savings alone may not be enough to outpace inflation. That means you save up money, but that money actually becomes less over time. And when you want to retire, it isn't enough to live off that money. By investing, you give your money the chance to grow faster than it would in a traditional savings account. Now, setting goals. Setting clear financial goals is one of the most important steps when starting your investment journey. First, ask yourself, what are you investing for? It could be for retirement, buying a home, or maybe just building long-term wealth. Knowing your goal will help you choose the right investments and timeline. Next, think about risk tolerance. How you need money in the next year or two, you might want to be more conservative. If you're investing for the long term, like 10 or 20 years, you can afford to take more risk. Finally, consider your budget. How much can you afford to invest? Even if it's just a small amount, consistency is key. You don't need a lot of money to start investing. So now that you know your goals, it's time to pick the right platform to start investing. You have a few options. You have investment apps, you have brokerage accounts. These are like your one-stop shop for buying and selling investments like stocks, bonds, and funds. Some popular platforms include Vanguard, Fidelity, and Robinhood. What you must know about brokerage accounts is that you probably have to pay money to the fund manager, so the one who will manage your money and your investments. Or you can take robo-advisors. If you're a beginner and want hands-off management, robo-advisors can automatically invest your money for you based on your goals and risk tolerance. When choosing a platform, as I already said, consider fees, how easy the platform is to use, and what types of investments are available. So now, understand different investment assets. Let's break down some of the most common types of investments you can choose from. We have stocks. When you buy a stock, you're buying a small piece of a company, and stocks can offer high returns, but they also come with more risks since prices can fluctuate a lot in the short term. Bonds are the most safe option. Bonds are like loans you give to a company or government in exchange for regular interest payments. They're generally less risky than stocks, but also offer lower returns. ETFs and mutual funds. These are collections of different stocks and bonds which provide instant diversification. They are a great choice for beginners because they reduce the risk compared to buying individual stocks. And we have real estate or crypto. In 2024, more people are diversifying into real estate investments and cryptocurrencies, but keep in mind these can be riskier and require more research. If you want to learn more about every asset presented here, watch our detailed video on investment assets for beginners. If you've watched some videos on investing, you've probably heard the saying, "Don't put all your eggs in one basket." And that's exactly what diversification is all about. Spreading your investments across the different types of assets like stocks, bonds, and funds, you can reduce the risk of losing money. If one investment performs poorly, the other will perform better. For example, a balanced portfolio might include 60% in stocks for growth, 30% bonds for stability, and alternative investments 10%. By diversifying, you create a safety net for your investments. To the next step, start small and build over time. You don't need to have a lot of money to start investing. In fact, many platforms allow you to start with as little as $50 or even less. For example, one strategy I love is dollar cost averaging. It means investing in a fixed amount regularly, regardless of how the market is doing. This way, you buy more shares when prices are low and fewer when prices are high, which helps smooth out the bumps in the market. Remember, investing is a long-term game. If you want to learn more about short-term game or trading, watch our other videos on this topic. Compound growth, where your earnings generate their own earnings, can significantly increase your wealth over time. As I already showed you and talked about it, many people expect their investments to go like this. But in reality, it looks more like this. If you want a more detailed topic on and the mathematics of compound interest, be sure to write down in the comments. So, once you're up and running, it's important to monitor your portfolio regularly. But don't panic if the market takes a dip. Ups and downs are part of the journey. That said, over time you might want to rebalance your portfolio. For example, if your stock grows significantly, they might now represent 80% of your portfolio, which could increase your risk. Rebalancing helps you get back to your original mix of investment. That means if your stocks go 80%, you want to buy in the next step more bonds, so you can have the same, as I already showed you, 60% in stocks, 30% in bonds, and 10% in alternative investments. Now that you know how to start investing, the next step is building a portfolio that fits your goals and risk tolerance. To help you with that, check out my video, Building the Ultimate Investment Portfolio, a step-by-step guide where I'll show you exactly in depth how to create a balanced portfolio that maximizes growth while minimizing risk. Click here to watch and I'll see you in that video. Goodbye.